Financial Accounting, Inventories, Part 2 of 3, Chapter 6. Let's talk about the 4 inventory methods that we've mentioned: FIFO, LIFO, average cost, and specific ID. Now we're going to use this through an illustration with the periodic inventory system because that's a little bit easier for the introductory student to understand. When you get into more advanced classes, it can get quite tricky. So under a periodic system, revenue is recorded every time, but nothing is used to show that inventory has been reduced and cost of goods sold has gone up. So at the end of the accounting period, the business takes account to see the cost of the inventory that's left over and figure out the cost of goods sold. Go back to that formula that I asked each student to memorize, and that formula is cost of goods available for sale is equal to ending inventory plus cost of goods sold. That means that out of the batch that you had available to sell, you either sold them. What we have in this problem, and we're going to start with FIFO, is 2,100 units. This is what we paid for them. We had a start of 1,000 units in our beginning inventory, and then we bought another 1,100. Here's the part that makes accounting challenging. Every time we bought a new batch, we paid a different price. So let's look at the FIFO method. And of that 2,100, what we find is that 800 are left over. And that means if 800 are left over, we can do some pretty simple math and say, and I've got to get my calculator out. That's a true confession. I'm not good at math. We can get our calculator out and we can say that if we have 2,100 units available to sell, that means that we have 1,300 sold, 800 left over. The question is, which 1,300 did we sell out of all of these, and which ones do we have left over? Using FIFO, we assume that we sold, and let me erase these so that it helps a little bit, I think. Using FIFO, we assume that the 1,300 we sold were these 1,000 and the cost of 300 from there. And that means that our ending inventory of 800 units is 600 of them priced at $23.30 and 200 of them priced at $22.40. In our bigger formula, we started with a $20,000 beginning inventory. We added the 2 purchase batches that we had, and there's that 2,100 units available at $45,180. Our ending inventory from the prior slide, you can go back in the video and watch, was $18,460. That is the cost of our ending inventory, which was from 2 different layers, 2 different batches. And when we do a subtraction, we come up with $26,720 cost of goods sold. And that is FIFO, the earliest cost, 1,000 from the first layer and 300 from the second layer. And you think of them as inventory layers because each layer has a different price. Here we go again with FIFO. 1,000 units here, 500 here in this layer, 600 in this layer. These are our purchases. That means that we have a total of 45,000. We sold 1,300, and the 800 that we have left, the cost is here. This is cost of goods sold, and this is the cost of ending inventory. Let's move forward then to LIFO. We're going to use the exact same assumption. We're going to assume that there are 800 units left, 1,300 sold out of the 2,100 that cost us $45,180. So what we find now is that calculating this is a little bit easier. Of the 800 that are left, it is the 800 from this $20 batch. And what we sold was these and 200 of these right here. So looking at the way that plugs into our income statement, we now have $45,000 in costs of good available for sale. Remember that formula I told you, remember? Cost of good available for sale. We subtract out the $16,000 that we have in ending inventory to find out a different cost of goods sold, made up of the most recent costs because it's LIFO, last in, first out. Different prices. And let's move forward and see how it looks. I think this really does help students. We got the exact same scenario here with the 3 layers of purchases, and we have the same goods available for sale as far as the dollar amount of $45,000. But this time under LIFO, our cost of goods sold is the last $1,300, and here we have it. We have $600 plus $500 plus $200. The $1,300 cost of goods sold is $29,180. It comes from starting at the bottom, the most recent, the last that came in, January 30th. Well, there are only 600 in that layer. Let's move up to here, January 10th. There's only 500. We sold 1,300, so we have to pull some of them out of here. 200 of them have to come out of here, which means that the 800 left over in ending inventory are from the oldest batch. So what confuses students? The word last in, first out. The last that came in were here, and we even had to grab some of these. And that makes up cost of goods sold right here. When we calculate ending inventory under the LIFO method, we are using the first ones that we had. That's what we assume is left in inventory. It's a little backwards, and trust me, it takes students a lot of practice to be able to completely understand these concepts. Specific ID method. I want to now give you an example that I have created using a new company, and I'm going to hope that you as a student, knowing what's important, that you will pause this video and see if you can calculate this problem yourself before I show you the answers. So we've got this Smith company, and they have 50 units in beginning inventory that they paid $9 for this item, $4.50. And they ended up with, out of their, looks like they've got 4 batches, they ended up with $3,600 worth of items. With this example, there are 50 left over and 300 sold. So which ones are they? How do we know which ones they are? So let's look at the question. Using specific ID, if ending inventory consists of 50 units at $10 each, that means if ending inventory is 50 of these at $10 each, it's really not hard math. 50 times 10 is 500. I can do that one. Then we find that there's 500 in ending inventory, and that would mean that the ending inventory consisted of ones that came out of this batch right here. And we can just do some simple math to find our answer for what cost of goods sold is. So let's see if you can figure out what cost of goods sold is before I reveal the answer. If ending inventory is 500, cost of goods sold is just a subtraction, 3,100. And I'm going to erase the ink on the slide. And need to make a quick correction to the slide without having to start all over again. Let's see, not sure if I can do that or not. Yeah. Not quite sure what this number's there for, so my apologies. I'm not sure where that came from. Here's our answer. Okay. Out of 3,600 total cost of goods available, and it's abbreviated here, goods available, total cost of goods available was 3,600. It's pretty easy. Let's go to the next example that I'm providing. This one's not in your book. Delete this typo up here. In this scenario, we're going to use average cost. What is the average cost of 1 unit, and from there we'll calculate it to determine cost of goods sold and ending inventory. I hope you'll pause here, pause the video, and try to work this problem yourself. Again, we paid $3,600 for 350 units available. It's a simple division to find out our average cost. Then we multiply this, we multiply this, and we can find out the answers to these two questions. Okay, so let's see what we've got. Here's average. $10.28. That's taking my 350 and my 3,600. So now all I need to do is take that $10.28, which I hope each of you calculated it, multiply it times 50, find out that it's 516, multiply it times 300 to find out that it's 3,086. And here's where we got the 516 in case you need some help with that. And we can see that there's a little bit of a rounding error, looks like I've got there. Not a big deal. Let's see. It looks like I'm a couple of dollars off. 516 minus 3,600. So yes, this should actually be a 4 right here to make the rounding better. Sorry, I can't type real well with a mouse. 3,084. Incidentally, in financial accounting, if there's a dollar or two missing, particularly for pencil and paper homework, it's not a big deal. It's sometimes hard on the programs that we use for your homework and for this time we're going to talk about LIFO. Same exact scenario. 3,600 units and 350 units costing $3,600. Using FIFO, what is cost of goods sold and what is ending inventory? So we've got two different ways to do this. This is the first time I'm going to explain it this way. If we assume that we are using FIFO, that means first in, first out. You change my ink color to yellow so it's a little bit easier. We're assuming that we're using FIFO. So the 300 units that we sold were the first ones that came in. That's 50 here, 200 here, and that's another 50 from here. So the assumption is that we sold all of these, and our ending inventory under FIFO is the most recent purchases, which is 50 at 12 or the 600. Here we go. This is our ending inventory, and this is our cost of goods sold. LIFO, same scenario. Smith Company, 350 and 360. Get rid of my error up here. And let's look at the using LIFO. What is cost of goods sold and what is ending inventory? Okay. So it's easiest, and that's why you see this problem done this way a lot. It's easier to count 50 than it is to count 300. So we go in and we say, LIFO says that the last inventory that came in is the first that goes out. So what is the price of the last 300 that came in? Well, it looks like the cost of these is the cost that I'm going to attach to cost of goods sold. And it looks like the 50 that are left over are these 50 at $450. So when we check our work, there's the 450 and there's the 3150, and the sum of these two is my $3,600. Now, I'm not going to pretend like this isn't hard information because it's really complicated for intro students. It's hard to see on an illustration this way. That's one of the challenges with online courses, is to be able to see an illustration of a problem. The best way to look at this is to maybe go back through the examples I've provided in this video, look at the examples in the book, stop and think logically. What does LIFO mean? It means that the last The cost of the last inventory that came in is my cost of goods sold, which means that my ending inventory that I'm trying to calculate here comes from this stash that I had at the beginning. And that's why this ends up here. And through some simple math, knowing that the sum of these two is equal to this one, then I can calculate my cost of goods sold, and I can calculate my ending inventory. And from this, I can plug it into an income statement, disclose to the users of my income statement which method I'm using, and there you have it. I hope that you'll, from here, work really hard and diligently to understand this as opposed to just kind of go, oh, this is crazy stuff. And please reach out to me if you have any questions. Now, part 3 of 3, we're going to just expand a little bit on what the effect would be on the income statement using these different types. A little bit less math entailed, none of these layers of inventory. But in the real world, using perpetual inventory, not periodic, it is much more complicated than this. But as we've talked about